From the retail sector to an investment that's historically been popular with retail investors, Muni Bonds. And believe it or not, this plain vanilla part of the market is garnering a lot more attention following the passage of the new tax law. Robert Frank explains.
One of the least glamorous segments of the investing world is suddenly a huge hit with wealthy investors. Municipal bonds, or Muni Bonds, have soared in popularity in recent months as investors look to offset big tax bills. Investor flows into Muni Bonds so far this year have topped $20 billion. That's the highest in 13 years. The main reason? Tax-free income. Investors who live in high-tax states like New York, New Jersey, or California are writing bigger checks to the government this month because of that new cap on state and local tax deductions. To create more tax-free income, those high earners are putting more money into Muni Bonds, which are exempt from federal income and often state and local income taxes. So if you have a 10-year Muni Bond that yields 2%, its taxable equivalent could be 4% or higher. All that demand has driven down yields in the $3.8 trillion market to the lowest levels against treasuries since 2001. And that has been good for the states, especially high-tax states that have been fighting the new tax law. 8 of the 10 biggest issuers in the first quarter were in California, New York, and Connecticut. New Jersey and Illinois were also big issuers, so the tax law has lowered the borrowing cost for the states most opposed to the new tax code. California last month issued a $2.3 billion bond deal that had an interest rate of about 1/3 of a percentage point below 2017. While that doesn't sound like much, it saved the state about $8 million. Politicians in those high-tax states saying the gains from the Muni bond boom can't nearly offset the billions that their taxpayers are losing to Washington.
I think obviously good resource investment into states is a good thing. Obviously helps with infrastructure and other things, but this is certainly not a long-term solution.
The big question for investors is whether the Muni mania has gone too far and created a new asset bubble. For example, yields on munis for Illinois, the lowest rated state in the country, are now below 3.6%. That's only about a point higher than the U.S. 10-year Treasury. For Nightly Business Report, I'm Robert Frank.